They both let you stash your cash securely, but they serve different purposes. Money market accounts and checking accounts are both useful tools for managing your money, and at first glance, they might seem interchangeable. After all, both hold your cash safely and give you access to it when you need it. But dig a little deeper, and you'll find they serve very different purposes. Checking accounts are built for everyday spending, while money market accounts are designed to help your savings grow with higher interest rates, while still providing some flexibility. Understanding the differences between money market accounts vs. checking accounts can help you decide where to park your money, so it's working for you and not just sitting idle. Let's get started. First, we'll tackle the basics of each account type before diving into the details. Then we'll explore how to choose between them. What is a checking account? A checking account is a type of demand deposit account you can open at most banks and credit unions. You can deposit money into your checking account by electronic transfer, check, or cash, and spend from the account as needed. As long as your financial institution is federally insured, your deposits are protected up to the federal limits. In the rare event it fails, that's right, the FDIC insures deposits at most banks, and the NCUA insures deposits at most credit unions up to $250,000 per depositor, per institution, per ownership category. Checking accounts don't have transaction limits. Instead, they're designed for frequent, everyday transactions, such as paying bills, buying groceries, and making online purchases. They also typically come with a debit card, checks, and online banking to provide convenient access to your funds. That's why, if saving money is your goal, a checking account probably isn't the best place for your cash. Many checking accounts don't earn any interest, and those that do tend to earn very low rates, with the exception of high-yield checking accounts. What is a money market account? You can think of a money market account, MMA, as a hybrid between a checking account and a savings account. You can open a money market account at a bank or credit union, and balances are federally insured up to the federal limits. Similar to checking accounts, money market accounts are easily accessible, often by way of debit card or check. However, banks may limit the number of transactions or withdrawals you can make from your MMA. Additionally, money market accounts typically earn more interest than traditional savings accounts, with the best money market rates today hovering around 4% APY. The downside is that MMAs can have high minimum balance requirements in order to earn the highest rates and/or avoid fees. Now that you know the basics of each account type, let's compare money market accounts vs. checking accounts across several key categories. This will hopefully help you see how they're similar and how they're different. Money market account vs. checking account. Key differences. Although MMAs and checking accounts have overlapping features, there are key differences that set them apart. Below are some areas where MMAs and checking accounts differ. Interest. MMAs usually earn competitive interest rates, while checking accounts typically don't. Minimum balance requirements. MMAs are more likely to have higher minimum balance requirements than checking accounts. This means you may need more cash to open an MMA, earn interest, or avoid monthly fees. Accessibility. Debit cards, checks, and online banking are usually standard features of checking accounts. On the other hand, not all money market accounts come with these features. Withdrawal limits. Checking accounts don't limit the number of transactions you can make. However, some banks impose monthly limits on MMA transactions. Purpose. Checking accounts are best for everyday transactions, while MMAs, with their interest and potential transaction limits, are better for short-term savings goals. So now you know about the accounts and how they compare. Now, let's talk about which is right for you. Which is better, money market accounts or checking accounts? Whether a money market account or a checking account is better depends on what you're really looking for in a bank account. Here are some scenarios in which one or the other might make more sense. When to choose a checking account. You need a place to handle everyday transactions. Along with using your debit card for daily spending, you can write checks and set up direct deposit from your checking account. You need unlimited and immediate access to your money. Checking accounts don't have the withdrawal limits that certain savings and money market accounts do. This means you can access your money whenever you need it. You don't have much money to deposit. Checking accounts tend to have lower or non-existent minimum balance requirements, so you don't need a huge chunk of cash to open an account or keep it in good standing. When to choose a money market account? You're saving for a short-term goal. Need a place to stash money for the near future? MMAs are perfect for emergency funds or other sinking funds. Expenses that require regular withdrawals but aren't necessarily predictable. For those predictable expenses, such as vacations or weddings, a certificate of deposit is another option. You want to earn interest on your cash. If earning interest is your priority, you're more likely to secure a competitive rate with a money market account compared to a checking or traditional savings account. You want to set up overdraft protection. If you have an existing checking account, you can link it to a money market account to cover overdrafts. Keep in mind, you don't have to choose between a checking vs money market account. You can have both account types and use them in tandem. For example, you can keep enough in your checking account to cover day-to-day expenses while parking your longer-term savings in a money market account. Or you could use a checking account to manage your budget and a money market account to save for a short-term goal. It really depends on your individual needs and preferences. The bottom line, MMAs and checking accounts are both solid options for holding your cash. By understanding their similarities and differences, you can choose the account that aligns with your financial situation and goals. We hope you found this video helpful. If you did, please hit the like button and subscribe to our channel for more personal finance tips. We've got plenty of videos that can help you become a savvy consumer. Thanks for watching.